There are people on the gold side who suggest that having a, quote, currency backed in gold will lead to amazing demand for gold. When they hear my objection that there isn't enough gold in the world to back up their transactions, their response very quickly and with delight is, not at this price, at a higher price. I suspect that those gold bugs who are looking at the BRICS and the BRICS settlement system to prop up the price of gold need to look elsewhere.
Rick Rule discusses the allure of a gold-backed quote currency and its implications for gold demand. He questions the feasibility of backing transactions with gold due to its scarcity. The chat extends to BRICS nations, their trade patterns, and potential Chinese dominance. Rick also touches on the inclusive approach of adding countries like Argentina and South Africa to the group. He underscores the motive of reducing U.S. hegemony and the changing role of the dollar. Throughout, Rule offers unique insights into currency, trade, and global influence. Stay tuned till the end of the video.
At current gold prices, that deposit may not have very much value because it's low grade and an awful lot of capital is required to put it in production. But if the gold price increases meaningfully, this will be a must-own gold deposit. The major mining companies around the world struggle to and do not succeed in replacing their reserves. They must be aware of the fact that they are madly producing gold when the circumstances in place to let the gold price go higher. From the majors' point of view, it would be a pity if the gold price went higher and they had a hole in the ground where their gold used to be. If we do see $2,500 gold, or if we do see $3,000 gold, what Rudy has been trying to do will become enormously successful. It will be a must-own deposit. Rudy very correctly says that his company has neither the financing nor the expertise, frankly, to build a $7 billion gold mine. Their job is to de-risk the project as much as they can and hold on to as much of it as they can, and then either sell the company or, preferably from their point of view, sell an interest in the deposit to a major mining company that has the technical expertise and the financial wherewithal to make the trade. And a higher gold price is what's required to enable them to do that. As you suggest, this is a very simple project. Well, they have a very interesting discovery, and it speaks to the love affair that our audience has with silver. Silver, as you and I have remarked, Albert, most recently at the Silver Boot Camp, tends to move later in a precious metals bull market. But once it moves, once the momentum has been established by gold, silver tends to move much further and much faster than gold does. And as our mutual friend Doug Casey points out, the most volatile asset class in resources to the upside are the silver equities, simply because they're so rare. Most silver in the world, of course, is not produced from silver mines. It's produced as an adjunct, as a byproduct from lead zinc mines, from gold mines, from copper mines. Silver producers, people who produce from primary silver, are therefore more leveraged and very much more scarce. As Doug Casey teaches, when the narrative switches to silver, which happens about once a decade, and the generalist money comes into the silver patch, there isn't enough market cap to contain the money. The upside that you see in the silver equities, particularly the better small silver equities, could be very dramatic. And I think that our audience base, some of them have experienced as many cycles as I, which is to say they go back in the business to the 1970s. And they understand that while silver bull markets are very rare, they are also very special. I think the specter of silver and its upside being out of favor, meaning that the equities are relatively dormant and relatively cheap, and a new silver discovery and a relatively small market capitalization has met a sort of an irresistible combination for our speculator audience. There are people on the gold side who suggest that having a, quote, currency backed in gold will lead to amazing demand for gold. When they hear my objection that there isn't enough gold in the world to back up their transactions, their response very quickly and with delight is, not at this price, at a higher price. I suspect that those gold bugs who are looking at the BRICS and the BRICS settlement system to prop up the price of gold need to look elsewhere. I think the possibility exists for Chinese hegemony among the BRICS, which I don't think will be well regarded, particularly by Russia and India, who have historical enmity towards China. I think from Russia and India's point of view, what it probably is insurance against the United States. I'm amused by the inclusion of Argentina and South Africa. The point of this for U.S. investors, and I suspect most of our viewers are U.S. investors, is that it is a blow to U.S. hegemony. I think, too, that U.S. investors need to understand that the enemies of the dollar are not in Beijing or Moscow or Delhi. They're in Washington. And the idea that our own actions are limiting our access to the exorbitant privilege of printing our own currency and exporting our problems. I remember Nixon's Treasury Secretary, John Connally, described the US dollar as our currency, your problem. I think that 50 years of the US abusing its exorbitant privilege means that in the course of my lifetime, that while the privilege won't go away, I think that the US dollar will still be the world's primary reserve currency for the balance of my life. For the record, I'm 70. I think that the degree to which we're able to benefit from that privilege will decline fairly substantially. And I think that's a pity from the point of view of all Americans, albeit less of a pity for people who live other places. Well, simply put, the fact that these countries became BRICS members yesterday doesn't change much around the energy market. The Saudis are still going to sell their oil. In the near term, if BRICS comes to pass, that trade balances will be settled in gold rather than US dollars. I'm relatively certain, as you point out, that there's a limit to the number of Argentine pesos, as an example, that the Saudis would like to control. Attempts by Argentina to impose hegemony on the rest of the world have been fairly halting, given the nature of Argentine defaults and their real skill at debasing their currency. I still believe that most trade in oil, including most trade in oil between BRICS countries, will take place in US dollars. That the Saudis, at least the Saudi crown, is rather sick of being told what to do by the US government. I think the extraterritorial imposition of US politics and US social norms has been offensive to everyone. I think the second thing, Albert, that we need to view is the other cause of this, which is to say the lousy arithmetic around US dollar denominated savings products. I remember myself being in an East Asian country that shall remain nameless and saying to my counterparty at the Sovereign Wealth Fund, when I learned that their Sovereign Wealth Fund had $3 trillion in US treasuries in it, I remember saying to my counterpart, from my point of view as a US citizen, this is a wonderful trade. You guys send us computers and ships and chemicals and cars, and we send you back pieces of paper with dreams painted on them. It seems to me, too, that the interest that we're paying you is probably nominal at best relative to depreciation and purchasing power. And I said, what would you say to the concept that the US Treasury as a savings mechanism is a lie? And my counterpart looked at me and he smiled and he says, yes, Mr. Rule, what you say is true. But yours is a deep and liquid lie, unlike the lie that other people tell us. And then I said, do you trust us? And he says, oh, no, but we trust you much more than we trust each other. I think we're to the point now, 15 years hence, where a US 10-year treasury, as an example, paying 4 in a currency that at least I believe on a measurable basis is losing 7% of its purchasing power compounded, notwithstanding that fabrication called the CPI, has meant that the lack of a real interest rate payment combined with extraterritorial attempts to impose US hegemony has meant that many countries see themselves as having no choice but to create a less optimal alternative.
Rick Rule's insights shed light on the complex interplay between currencies, geopolitics, and evolving global dynamics. As discussions of a gold-backed currency challenge conventional thinking, Rule's exploration of scarcity, trade patterns, and the BRICS nations provides valuable perspectives. The quest to reduce U.S. hegemony and the evolving role of the dollar offer food for thought on the future financial landscape. Rick Rule's reflections serve as a catalyst for deeper contemplation on the forces shaping our economic world. I hope you enjoyed today's video, and let's keep it going by liking, sharing, and subscribing. Thank you.